Our big story tonight, it's one of the main cues to watch out for if you're in the markets or even if you're not, because it determines so much. The US Federal Reserve's monetary policy meeting and its outcome, we'll know today itself. It's going to be a crucial meeting. It comes on the back of a banking crisis and it could prove to be an inflection point. So what exactly is at stake over here? Which are the factors that the Fed will really go through to determine what their next monetary policy move should be, keeping in mind all the moving pieces? Let's break it down. My colleague Anisha is joining us to walk us through all that is at play. Anisha.
Oh, well, yes, the Fed meeting is going to be very crucial this time around because this is the first one which is coming after the collapse of the Silicon Valley Bank and the Signature Bank in the US. So the commentary from Fed Chair Jerome Powell on the health of the financial system in the US will be very, very critical to watch out for. And what are the plans to stop the contagion effect or the deja vu of 2008 would be fairly important. Also, it's critical to watch out for any commentary coming in from the deal between Credit Suisse as well as US, UBS. So what does it mean for the entire banking sector as a whole? And also, it's coming at a time when the rate is at a very interesting juncture. Remember, there were these talks at the time of last meeting that perhaps we have reached the peak already and there is going to be a pause. But now the expectation has turned a tad bit. There is still part of the street which is expecting a 25 basis point hike. But having said that, the most important would be this time whether Fed Chair Jerome Powell continues to stick to their ground to rein in inflation the way ECB had done with a 50 basis point hike recently, or do they turn into a bit of a dovish tone given what is happening with the financial collapse of the banking system in the US, and they try to sound a bit more dovish and talk about probably rate cuts happening towards the end of the year. That's the thing that the market will watch out for. Also, this time around, there will be an update or a revision coming into the summary of economic projections. So that will be also critical to watch out for.
All right, Anisha, thanks very much for that. Let's get further perspective. Mythili Bhusnurmath is our consulting editor here at ET Now, and she's joining us on the show. Mythili, good evening to you. And yes, first off, do tell us about your expectations of the Fed this time, because many in the past have been critical about the Fed's rate hike decision. They've said that they've come in too late to fight that inflation fire. And that fire, clearly, Mythili, has raged on. Their target, of course, as far as the Fed is concerned, is 2%. And right now, around 6%. They have some way to go. Do you believe the Fed has the tools? Does it have the firepower to hit that dream level of inflation right now? Or have the bank failures cleared the pitch for them?
Well, the Fed, like all central banks, has essentially only one tool, which is to hike interest rates, which is what they have done. But as you mentioned, the Fed did come into the battle a little late because for a long time they kept insisting that the price hikes that we were seeing were only transient, temporary. And because they came in so late and because monetary policy acts with a long lag, even in a market like the US, the lag is about 3 to 4 quarters. So since the Fed started raising rates only in March 22, it still hasn't seen the effect of those rate hikes. So even though it has raised rates about 450 basis points since March last year, we're still seeing inflation at over 6%, way above its target, as you mentioned, of 2%. But there's really nothing much that the Fed can do at this juncture to get inflation back under control and without giving up the fight. They have to continue their fight on inflation, which is why just about a fortnight ago, Jerome Powell, in his testimony to the Congress, has said that we will continue to fight. And in fact, he indicated that they might, be even sharper rate hikes than in the past. Suddenly, of course, the bank failures have cleared the pitch a bit. But I do not think the Fed can afford to relax its guard on inflation, because the mandate to the Fed really is to keep price stability with an eye on growth. So as with the Reserve Bank of India, financial stability is a factor, but that's not really the direct mandate of the Fed. So my sense is that unlike in the past where it might have hiked rate by 50 basis points, they will still continue to hike rates, but maybe by a lesser amount of about 25 basis points. Simply because once you come into the battle late, then you really have no choice, which is what we saw with Paul Volcker earlier, and we're seeing now with Jerome Powell. So the Fed is paying for its own sins, first of excessively loose monetary policy for much too long, and then for joining the battle much too late.
So if the Fed has to pay for its sins, Mythili, many would say that it's the kind of interest rate hikes that came in that triggered the kind of banking crisis that we are currently witnessing, and it's spreading across the world. So a lot of this contagion, the Fed would have to take some of the onus on, and if it does, then like you said, the one tool it has is to tinker with interest rates. So is that going to be something that they will do? Or you think that they are going to go with what Powell has said very stridently, that growth is not something that is part of their agenda?
Well, I don't think, the Fed, you can blame the Fed really for the fact there was mismanagement on the part of the banks. Because as the Fed said very clearly, ever since they started hiking interest rates, it was very clear that they're going to continue to hike interest rates. So there was really no reason why the bank managements did not hedge their bets and did not mark their asset portfolio properly to market. And let's also not forget that the Fed supervision, the supervisory role, regulation and supervisions in the US are not remotely where they ought to be. After the 2008 crisis, we did see the Dodd-Frank Act being passed, but subsequently some relaxations were made. So I think the Fed and the entire US bank supervisory system has a lot to answer for the failures in these banks. So first, there was mismanagement at the level of the banks, and there was gross underperformance of the Fed and the remaining supervisory arrangement because it's very fragmented in the US. Unlike in India, where the Reserve Bank of India is a sole supervisor for banks, the US has a much more fragmented system. And it is really quite appalling, if I may use that word. And this is actually, the Fed is paying the price, not so much for its interest rate hikes, but for the failure, the lacuna in the US supervisory systems.
Mythili, then, in this scenario, how much of a contagion lies ahead of us? As far as the Indian story is concerned, how much of the financial instability in the rest of the world do you think is going to come to our doorstep here in India? Is it going to be the Fed's decision on interest rate hikes or not? Whatever it is that they go in for, is that going to affect our economy more? Or do you think there is the fear of financial instability as well, what we're witnessing around the world, that might really come home too in one form or the other?
Well, in the case of Indian banks, the direct exposure is very minimal. So I don't think there would be much fear of contagion through the banking system. But what does happen to the US economy has a huge impact on all countries all over the world, including in India. So this is what we saw in the 2008 crisis also. It was not the direct contagion through the banking system. But when the US economy goes belly up, as it were, then the entire world economy also suffers. And that is what we are likely to perhaps see if the US Fed and the US Treasury is not successful in containing the contagion within the US banking system at the moment. They've learned their lessons from the 2008 crisis when they allowed Lehman to go under, and then the whole world paid the price for the US folly. The tragedy is that as far as banking is concerned, it is heads you win, tails I lose. So ultimately, taxpayer money has to come to their rescue of a bank which is too large to fail, but the consequences of not doing so are far too catastrophic, which is why regulation and supervision of banks is so critical, which is also why banking alone remains a licensed industry all over the world.
So on the regulation front, I'm sure you believe the RBI has done much better than the Fed. But as far as cues on interest rate hikes are concerned, Mythili, do you think the RBI, which has been in sync with what the Fed has done with interest rate hikes, as far as the situation now is concerned and what the Fed decides to do, how much of a bearing is the Fed's decision tonight going to have on the RBI's next monetary policy? Will the RBI focus on growth, you think, or is it going to now focus that much more on inflation?
Vikram, I don't think the RBI will agree with you that they've been in sync with the US Fed. I think they have, because the US Fed, as I said, is the central bank for the entire world. But the RBI has always gone out on a limb to say that our policy is determined by our own internal factors. Of course, internal factors play a part, but in a globalized world, the US Fed's policy also plays a huge part. But having said that, financial stability, I think at the moment is not at risk in India because there are three major differences. One, because unlike in the US, our banks are not dependent on wholesale deposits. Our banks are dependent on retail deposits. So it is not as if one large depositor decides to pull his money out and the entire bank has liquidity problems. So regulations are much tighter. And the third reason really is that banks in India, investment is a relatively small part of their portfolio. Credit is a much larger part. And credit portfolios are not marked to market. Only investment portfolios are marked to market. So I think the banking system is by and large safe. So the RBI, I think, can take a call between growth and inflation. Of course, financial stability, as I said, is important, but not as critical as in the US because we haven't seen any bank runs in India and we are unlikely to because a major part of the banking system is also government owned. That makes a huge difference. So I think the toss up will still be between growth and inflation. But remember, the minutes of the last MPC meet already showed that there were sharp differences within the MPC with two members calling quite vociferously for a pause. And I think there might be a case to pause on inflation, on interest rate hikes, and maybe sound a little hawkish as far as commentary is concerned, because growth is slowing down. And if the US economy slows and if there's recession all over the world, we cannot really afford, not to kind of pay heed to that. So I think there might be a case for a pause in the Indian context, given that growth is hurting and given that RBI again did come in late to the fight against inflation. So I do not think at the moment, I think it makes more sense to watch and wait, talk hawkish, but have a pause on rates would be my sense. But I don't know. As I said, the MPC is perhaps, has a different view, but we do know that there are two members in
Correct.
the MPC who definitely felt that way.
Absolutely. But Mythili, now if the Fed decides that it's going to pause or if it's going to go in for smaller interest rate hikes right now, it would mean that it would stay higher with those interest rates for longer and keep that focus on inflation. In that scenario, how hard is the landing going to be? How deep is a recession likely to run? Because that's going to have a telling effect on the global economy, and India is not going to be an exception, right?
Well, at the moment, the US economy, if you look at the labor market, it's still running very hot. So there don't seem to be any signs of recession. The bigger worry right now is about banking stability. If the banking system is stable and the contagion is contained, then I think the US might not necessarily have a hard landing. Yes, the US will not grow as fast as before, but that is an inevitable. And as long as you don't have a recession in the US, I think we're in fairly safe waters. But at the moment, I think it's a toss-up. One really doesn't know which way it'll pan out. Because as we saw 2 weeks ago, Powell was saying, I need to hike interest rates. And suddenly there's a talk of a slower rate hike or a pause, or people are even talking of a rate cut. That I don't think is going to happen because inflation at 6%, your target at 2%, it just does not make sense to cut interest rates.
So the way the Fed moves from this point onwards and its immediate rate decision, do you see a likely impact on the Indian economy and the growth story?
Well, if the Fed hikes, in that case, the margin between their rates and ours will widen as compared to now. You could see a flight to safety. You've already seen foreign portfolios, investors leave the country, sell and leave. So that might impact our portfolio flows. But as I said, it's more through the economic channel, the economy channel, that I think the Indian economy will face the impact, not so much the rate channel.
We'll keep watching the situation and keep checking in with you, Mythili. Thanks very much for giving us perspective and insight into the likely scenarios of the Fed's decision tonight. And of course, it's going to come out soon. And of course, we'll keep watching the situation in our part of the world as well. Mythili Bhusnurmath, Consulting Editor at ET Now. Many thanks for joining us on the show.